Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello everyone, my name is Manpreet and welcome to Through the Noise. Now, in a relatively turbulent start to the year, we're back to focusing on the Fed and Fed policy because discussions around Fed governorship aside, we've got some interesting data from the US job market, which, if anything, supports the case for further rate cuts. So, how do we read some of the recent data in light of Fed policy and what does that mean for asset class views? To discuss that and more, I'm very happy to be joined today by Heung, who's a senior investment strategist at the CIO office. Welcome, Ray. Let's jump straight to the Fed discussion then. I know we have a view of 3 quarter-point rate cuts in 2026 from the Fed. In your view, does recent data change anything, or is the market correct in expecting fewer than that today?
Thank you, Manpreet, for having me. In fact, this has actually have been good debates in the marketplace. And yes, we do notice that the market is actually now expecting slightly less rate cuts than us. But we are continue to see 3 cuts on the cards because of 2 main reasons. Number one is the stalling job market. And we saw the job market contracted in quarter 4 2025. It is actually the first such quarterly retrenchment since the COVID crisis in early 2000. Now, in December, 50,000 non-farm payroll jobs were generated versus the 70,000 expected, and prior 2 months, payroll were revised downward. And this is actually extending a pattern of downward revision throughout the 2025 year. So tight supply of workers due to immigration curbs lowered the jobless rate to 4.4%, although the rates remains above the Fed long-run equilibrium rate of 4.2%. Now, the second factor is softer than expected U.S. inflation. December core consumer prices actually rose 0.2% month-on-month versus 0.3% expected. And on a yearly basis, core prices rose 2.6% year-on-year versus 2.7% expected and unchanged from November 4-year low. So with a soft job market reinforcing the Fed's latest Beige Book survey, is likely to sustain the wage and shelter disinflation. While last year's acceleration in productivity also offset the impacts of tariffs on goods inflation. So bearing a spike in oil prices, we do expect inflation to gradually decline this year. It is already reflected in the 1-year inflation swap, which has fallen to about 2.4%. And long-term inflation expectation also remain fairly subdued. So these 2 factors combined, I think, suggested the Fed will likely remain on an easing bias. And we do expect the 24 basis point cuts to deliver in March, and then 2 others within the remaining of 2026, and therefore keeping a 3% Fed funds rate targets by the end of 2026.
Thanks, Ray, for that context on macroeconomic data and policy. Let's jump to equities first. U.S. banks are starting to report earnings. What do you, in your view, what are those earnings really telling us? And should we worry about Trump's proposed interest rate cap?
Yeah, I think to answer the first question about the U.S. banks earning first, the U.S. financial stock actually are positioned for pretty healthy earnings growth and still remain a core holding for us. We think existing investors should retain their holdings, while those underallocated to the U.S. financial can actually use the current pullback to build their exposure in tranches. If you look at the major U.S. banks' earnings, so far seems to be mixed, with earnings generally beating consensus and revenue being missed only in some instances. But overall, bank earnings point to a stable U.S. economy, and that supports positive loan growth and controlled credit risk. A continued increase in capital market activities and a focus on efficiency will also support healthy earnings growth in 2026. Now, regarding the interest rate caps, we view that is actually something unlikely to be passed, given the current lack of support in the Congress. But anyways, even if this is being passed, this proposed 1-year 10% credit card interest rate cap would significantly impact the credit card issuers' earnings, as mostly currently charge over 20%. But I think Deep down, the card issuers would likely mitigate the earnings impact by tightening lending standards and increasing fees and also reducing the rewards.
Thanks, Ray. Maybe returning to bond markets then. The other, big announcement, of course, was the announcement of the mortgage-backed security purchase program. In your view, is that likely to have a big impact on the bond market?
Well, for the MBS market, the 200 billion number actually sounded big. And obviously, the motive for Trump administration is to lower the mortgage rate and improve the profitability. And we also seen the MBS market has already reacted po the news. And if you look at the yield premium, it's actually narrow. But we see that yield premium compression can fade if the effort is just a one-off and not a continued one. For one, if you look at the size I just talked about, the 200 billion, it's roughly about 2% of the total MBS market. So it will have an impact, but the overall size is still relatively small. Second of all, if you look at Fannie Mae and Freddie Mac, each of them has actually got a 225 billion portfolio caps. And so compare with the 200 billion announced, and if the caps are not lifted further, it means both of these GSE would not be able to buy more to impact the market. So with regards to the impact to the ABS market, we see the direct impact as fairly small, as the ABS are not the targeted securities, and they would only be benefited if there's any spillover effect. So overall, we believe investors should be using government bonds rather than MBS to express their interest rate views.
All right, that's a clear view. Now, commodities. We're never far away from a discussion on precious metals. Silver again. We've seen sort of strong gains. Gold continues to rise. Do you expect these, precious metals to continue extending gains over the next few weeks and months?
Yeah, thanks for that, Manpreet. For silver, a nice rally into 2026 and already reaching 90 US dollar per ounce this week after breaking the prior $84 per ounce resistance. Um, one of the stimulating factor, obviously, is the geopolitical tension, right? If we look at the gold-silver ratio, now has declined to below 51, approaching the low 50 range that has historically marked a more consistent drop for silver. If we're excluding the 2011 extremes, right? So for further silver outperformance, I think at this point we would need gold to exceed our base case expectations. While if we look at the momentum indicators, confirms the border uptrend remain intact, I think near-term positioning appears quite stretched. So raising the risk of a healthier consolidation in our view. So a pullback towards $82.5 per ounce would be constructive in our view, and that will allow for the rebounds towards $96 per ounce, which is consistent with our gold silver ratio at 50 and also a gold price target of 4,800. If it actually breaks below 82.5 per ounce, I think that will signal a deeper consolidation. Now, turning to gold, the metal has also extended its strong year-to-date rally, gaining roughly 6% as investors shifted to safe haven assets, and also with the ongoing geopolitical tension and concern over the Fed independence. We do expect these concerns to continue to support gold prices, though positioning also like silver is a bit stretch, and therefore which may cap the near-term upside. We think the next resistance level would be at around 4,727 ounce US dollar per ounce. And on a related note, our gold miners opportunistic equity ideas has performed fairly well and is up over 30% since initiation in last October, and also outperforming the gold price itself. We do consider taking profit on gold miners idea before, but we decided to keep it open as we see further upside in gold prices, and we will be monitoring the idea fairly closely.
Thanks, Ray. And finally, very quickly, geopolitics back as a focus in the Middle East. Does that impact your view on oil prices?
Yeah, I think definitely has an impact to the oil prices, despite there's actually no material disruption to the physical supply at this point. And fundamentally, if we're talking about demand-supply situation, this is actually estimated by the U.S. Energy Information Administration. It's actually still show a surplus of around 3 million barrels per day in 2026. This suggests that near-term balances are not enough to drive a sustained oil rally. We do think that material upside risk in oil would require a broader escalation, and notably geopolitical tension, regional tension, which could lift the short-term prices towards $65 per barrel. A major event is needed to move the needle on spare capacity and sharper oil prices. Therefore, we do maintain a 3-month forecast of $61 per barrel on the our WTI crude. On a related note, again, we favor U.S. tips as a protection against oil-driven inflation risks, and also remain tactically bearish on dollar Canadian, given the pair sensitivity to high oil prices, and we target a move towards 1.364 to 1.3720.
Okay. Well, I think that brings us to the end of time. So thank you very much, Ray, for joining us on today's podcast. If I can summarize the top takeaways, number one, obviously, if you're worried about geopolitical risk, consider inflation-protected bonds and the Canadian dollar as potential hedges. Number two, gold and silver both facing very strong momentum, but watch that gold-silver ratio, and our preferred catch-up trade remains gold mining equities. And third, let's consider taking advantage of any rebounds in bond yields, but keep the focus on the U.S. government bond market rather than MBS. So thank you all for listening to today's podcast. We hope you enjoyed it, and we look forward to speaking with you again next week.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.